The global economy relies on materials that are incredibly volatile, whether it's oil for energy, wheat for food, or raw metals for construction. Sudden price fluctuations pose an existential threat to businesses and investment portfolios alike. To manage this chaos, the financial sector uses a specific tool. Looking at this text, we see the definition of a derivative, a financial instrument whose entire price and value are tethered to an underlying asset, like a barrel of oil or a stock market index. As the document highlights here, the primary purpose of a derivative is hedging. This allows portfolio managers and commercial businesses to lock in prices today, neutralizing the impact of adverse price movements tomorrow. But scrolling down, we find the offensive uses for these same contracts. Speculators use derivatives to profit from predicting asset price direction, while arbitrageurs use them to exploit mispriced assets across different markets. One instrument serves two entirely opposite purposes. It functions as a vital insurance policy for the risk-averse, while simultaneously creating a high-stakes arena for traders looking to profit. The most direct way to lock in a price is through a futures contract. This is a legally binding agreement between two parties to transact a specific quantity of an asset at a predetermined future date. This diagram illustrates the long position. Here, an electricity company commits to buying 1,000 barrels of crude oil at $56 a barrel, locking in their energy costs and shielding themselves from future price spikes. On the other side of that exact same contract is the short position. The oil producer legally commits to selling their barrels at that same $56, guaranteeing their revenue even if the global market suddenly crashes. When we chart these futures prices against current market rates, we sometimes see this upward sloping curve. This is known as contango. It occurs when the futures price is higher than the immediate spot price, usually to account for carrying costs like storage and insurance. But if supply is suddenly constrained or immediate demand spikes, the curve slopes downward, crossing below the current spot price. This state is called backwardation. By legally binding both parties to their predictions, futures contracts replace the anxiety of market volatility with mathematical certainty. While futures obligate you to buy or sell, this text outlines a different mechanic. Options contracts grant the buyer the right, but crucially not the obligation, to transact at a set strike price. As detailed in the following paragraph, this flexibility comes with a financial cost. To open the contract, the buyer must pay a non-refundable premium to the seller. Scrolling down to the terminology section, we can see the two core variations. Call options grant the right to buy the asset, while put options grant the right to sell it. The text also outlines a strict power dynamic here. The holder buys the option and holds the power to exercise it, while the writer sells the option and must comply with the holder's decision. Looking at this payoff chart for a call option, we see how the mechanics play out. The holder secures a net profit only if the underlying asset's price rises above their set strike price, plus the cost of the premium they paid. This creates an asymmetrical risk profile. For the buyer, maximum losses are capped at the initial premium paid, while their upside potential remains completely unlimited. Derivatives require buyers to pay only a fraction of the asset's total value, the premium or initial margin, to gain full market exposure. This creates immense leverage. Referring back to our terminology list, we see how traders measure this leverage. An option is in the money when its strike price is immediately profitable compared to the current market price of the underlying asset. Conversely, an out-of-the-money option is priced unfavorably. Exercising it right now would result in a strict financial loss. By combining fractional upfront costs with precise break-even thresholds, derivatives allow traders to artificially amplify their market returns. There is a counterintuitive reality to all of this tracking and trading. Despite representing thousands of barrels of oil or tons of wheat, the vast majority of derivative contracts are never used to actually physically exchange the underlying commodity. The manual explains why right here, under the Close bullet point. Traders simply sell their long contracts or buy back their short contracts to exit the position before the expiry date even arrives. Portfolio managers utilize these paper-only trades constantly. It allows them to rapidly adjust their asset allocations and anticipate future cash flows without the burden of holding excess cash. This flowchart reveals the ultimate macroeconomic function of the derivatives market. It operates as an engine to transfer financial risk from those who cannot afford it, passing it through the market directly to those willing to gamble on it. Through derivatives, risk transforms from a dangerous, unavoidable hazard into a highly precise commodity that can be systematically measured, traded, and controlled.